Moving on to the other big updates we're tracking, the international credit card expenditure done outside India would now come under the Liberalised Remittance Scheme, also attracting a higher, that is 20% TCS with effect from July 1. While this has been done to track those who are not disclosing their accurate income, especially when they spend overseas, and increase India's tax base, there has been widespread confusion and anger amongst the public on this added burden on them, especially the salaried middle class. Before the Union Budget 2023, the TCS under the LRS was at 5% for remittances that exceeded 7 lakh rupees. With the new hike of 20% TCS from the previous 5%, everyone will have to pay this amount except those who are engaging in transactions related to medical treatment or education. The traveller can claim this TCS credit while filing their tax return, but it has added a layer of paperwork and even a delay of more than a year before you can get your money back. Now, the government did follow up with some clarifications, although that hasn't been enough. For example, it is clear now that if you buy goods and services while you're sitting in India using your card, even if the payment is made for a foreign goods or services overseas, that is not going to come under this 20% hike. But any expense you make while overseas for travel bookings, etc., or directly to hotels and so, gifts to NRIs are part of this new rule change. The government has also clarified that company and business trips are exempt from this hike, but it is not clear how to establish at point of sale that an expense is personal or otherwise. Purchase of property, real estate overseas, though, are part of this hike. Education, tuition fees and medical payments will not witness this TCS hike, at least to a certain level. Whatever was the old model remains effective for that. But investment in stocks outside India will attract this new rule. And finally, and there is some confusion here, if you buy a tour package on your credit card in Indian currency from an Indian tour operator, it will not attract the 20% TCS. That's what we've been given to understand. Spends on purchase of bonds, though, will attract new rules overseas. But for everyone now, travel abroad is more expensive. In simple terms, if your entire expenditure on your cards while overseas was 2 lakh rupees, now you pay effectively 20% more. So actually your bill is going to be 2,40,000, even though you can claim that 40,000 rupees back, but only in an RTI filing. So the big debate coming up, and we have experts joining us in just a bit. It is a new rule that was announced in the budget. There's been parity between debit and credit cards brought in. But even if this rule is well-intentioned, is it ultimately extremely public unfriendly? Let's go across to our guest joining us. Ajay Roti is founder and CEO, Tax Compass. Hemant Sood is promoter and managing director of FinDoc. Thank you, gentlemen, for joining me. Ajay ji, I'm coming to you first up. I think the fundamental issue that people have is, yes, you need to track transactions, and there was a debit card rule already in place. But why did the TCS have to be 20% and not a nominal 1, 2, or even a 5%?
Yeah, unfortunately, I too don't have answers for that. I think it should have been a lower percentage because typically, whether it is TDS or TCS that's there as tax collected at source, and there's a fundamental difference between the two, is with twofold that they do. One is really to collect data of the transactions which happen so that there's no leakage and people don't not disclose transactions. Second is also to collect money as and when transactions are happening. But that's more on TDS because that results in an income which is taxable. So you collect it not once at the year end, but it gets spread out. In case of TCS, which is already, has existed in a few other transactions like purchase of luxury cars, etc. The TCS has always been a very nominal percentage. It could be 1% or even the TDS on real estate transaction, where the government believed that there could be cash transactions was 0.1%. So ideally, this could have been a lower percentage if the intention was to collect data of the transaction and to ensure that they come into the tax net. But by that logic, even credit cards should not have come in, because credit cards are always tracked and the data of credit card transaction was always available with the government. So
why then?
I really don't.
Ajay Roti, why then? Then if, that's what the other question is, that it's on mind of the public. If credit cards are already linked to your bank account, the bank accounts are linked to your Aadhaar, why then do you need this?
So
and that too, why should I pay 20% tax on an item I'm buying? I've already paid tax on my income.
Yes. So there's another angle to this, which is not a tax angle, which is really the Liberalised Remittance Scheme. So that's a RBI scheme which permitted resident Indians to remit money in foreign currency abroad up to $250,000 per year, per financial year, starting 1st April until 31st March. Now, the government yesterday, when they issued the clarification, which is actually in form of a tweet by the finance ministry, they state that the reason we've got this in is because the government has data to believe that people were circumventing or exceeding the limits under LRS by using credit cards. Therefore, they got credit cards into LRS. Then there are two reasons. One is it to widen the tax base, or is it actually a foreign exchange issue which has an unintended tax consequence?
Okay.
Not very clear on which of the two is the primary reason, but there could also be this foreign exchange reason to ensure that there's a clampdown on use of credit card to exceed that limit.
Fair enough, but is it not, Hemant Sood, throwing the baby out with the bathwater to track a few of those individuals? Now, everyone who can afford to travel overseas and spend overseas is going to come under this net, and 20% is a lot of percentage. It's a big percentage.
I completely agree with you, Shivani, and I think there is another problem in the compliance of this tax regime, because, for example, imagine an employee of a company goes outside to travel for a work, and his PAN card is attached to that credit card, and he comes back and 20% tax is deducted on his personal PAN card, and he claims the expense from the company. Company will say 100% take the back, 20% from the government. So as like my other fellow gentleman has said, that the tax, if government really wanted to track, they could have done with 1% or 0.1%. And mind it, this is an expense, this is not an income. And imagine the IT companies who have a lot of offshore work. Their 80-90% of the turnover is outside India. People paying on their credit card, and imagine the 20%, and there will be a cash flow problem for a big, large IT service corporate companies.
No, so
also.
In the finance ministry's clarification, they sought to do exactly this. They sought to allay the fears of the IT industry, especially saying that company and business trips are not going to be taxed at this rate. But do you feel, and these are responses I've received, for example, on my tweets, how do you establish what is company and personal expense? When we travel overseas, we get this Forex card. But
that's what I'm trying to say, that there will be a lot of compliance to distinguish between this is a corporate, this is a company, this is and there is some exemptions also, like education and imagine you're buying some education course on online, and which is not a university, and you say this is an education expense. How you will tell the government, how they will identify with them? And there will be, I think, the government purpose to track data which was already available with them. If they really wanted to do it, they should have done with 0.1% or 1%. Or if they are worried about the LRS, they should have made the limit to $150,000 or something like that. So that there's a less burden on the compliance for a common man. So that's my take on it.
Ajay Roti, I want to ask you maybe some clarifications, because I've been also racking my brains. The government did clarify that if you're sitting in India and you're shopping and you're essentially shopping overseas to an overseas seller, then this rule doesn't apply. Am I correct?
Yeah, so that is there in the clarification. But one thing, very important to note, this clarification, FAQ, whatever is issued, has just been shared on the Twitter handle of the finance ministry. This, in my view, at this point, does not have a legal backing. Of course, it may be followed with a circular which will be issued, which has a legal backing. And the point Hemant was making on business travel is also covered in that. But unfortunately, what they've done is, they say that the bankers have to verify whether it's a bona fide transaction. Now, how will a banker know that if an employee travels abroad, swipes his card at a hotel for a stay? Now, how will the bank at the time of swiping know whether it is for a personal travel or a business travel? And where do you get in that paperwork in terms of intimating them that this is a business travel, please do not collect tax? Because remember, this is a tax collection at source. It's not a deduction. Therefore, the bank will increase the credit card bill by that 20% and send you a higher bill. And how do you change? How do you get that change? I think this is just implementation is going to be a nightmare, even if it's even if it has to go ahead in the same form.
Yes. And Hemant, so the other question people will have is that you'll ultimately have to keep all of these bills while you file your ITR. Is that so? Or will your credit card statement be enough?
I don't know how the compliance and imagine when your ITR is up for inspection or what you can call as for scrutiny, and that officer will view a same transaction on a different lens. He can say, if you are having a lunch, tell me what were you having a lunch with them? What was the business consequence? You don't know. So it will be a really a nightmare to enforce this. If there are a lot of distinctions, if there is no distinction, 20% flat is easy to enforce, but that's not practical. So my suggestion would be they should, if they really want to track it, they just impose 1% flat, no waiver. So at least it is. You can comply with.
Yeah.
But if you have to submit a lot of documents to your banker, and I think there will be one more problem. There will be a lot of credit card disputes with the bankers. I think the bank will have to suffer a consequence because, for example, there will be some lag between submitting the document. If the banker has to verify this is a personal, this is a business expense, and the bank team may not be able to reverse that on a time. Then there will be gap between the payment and the due date. And then the Commonwealth will fight with the banker. I am not going to pay with interest. I think these are the practical consequences. If the banker has to verify, if the banker will take time, and they may not agree to your suggestion whether this is a business or a personal. Then they will go back and forth.
So Hemant, you are saying that the better thing to do, and let's wait and
will also get affected.
Let's wait and see if the government or the finance ministry does anything in this regard. But everybody's saying the better thing to do is to to slap a nominal charge. Those who don't want to be stuck in compliances can just forego that 1% charge. But at least everybody will not have 20% of their income stuck till they file an RTI. And you can also then track those transactions where you find any problems with the income and the expenditure. Ajay, what would you like the government to be doing here? Would you say that this is the best solution, and do you expect the government to be rolling back?
See, I think in terms of the intention, it's right that you will need to track the transactions. You would not want evaders. You would not want money to be moving out of the country without a trace and without a reason for the government to be tracking it and people not to be offering it to tax. But it's really the rate that I have a problem with, because 20% is too big a number to be blocking us with the government for a refund for a long time. I think there also are too many issues with implementation, because you are doing it for a credit card, and then how will the banks track it, etc. So one is the rate, and second is really to look at a flat rate, which is a smaller rate. Then really the type of transactions, etc., don't matter. Fortunately, keeping track of these is not a problem in the current age, because the government system of tax credits, your Form 26AS, all work well. It gets populated against your permanent account number. It appears in your account when you log in. It gets pre-populated into your return. So that whole thing is working absolutely fine now. So I think if they, just change the rate, according to me, this should work, because from an intent perspective, I think it's not bad. It's something that you need to stop the evasion. Is 20% a rate that we should?
Yeah, is 20% that rate? And maybe they thought that it is for people who are anyways not disclosing their income, so they'll just get that 20% tax cut, and then the government wouldn't have to chase them. But in the meantime, Ajay, my final question: has the government miscalculated just the sheer number of people in India who would be badly, adversely affected by this? Because the government maintains this is for high net worth individuals. In today's day and age, you don't have only high net worth individuals traveling abroad. That's a fallacy.
Yeah. So I think the pushback, you're absolutely right. I think the pushback is again on two counts. Because see, this 5% rate on LRS and foreign travel has remained on the books from October 2020. We've not had that pushback there because the rate was still reasonable. So there was no pushback. Today, that rate is going up to 20. That's the first reason for pushback. Second is, once you got in credit card transaction without a clarity on transactions which get covered, then you and I paying for subscriptions, etc. That is what has caused the pushback and caused the outrage that we've seen over the last few days. I think the government did think it's for a very, very small set of people who are investing abroad, wiring money abroad, etc. But the credit card usage for even smaller transactions are quite high. I think
Yes.
that's the reason for this outrage.
All right, I leave it at that. I do thank both of our guests for joining us. Let's wait and see what happens as far as this new financial rule is concerned. I have to slip into a very short break. On the other side, there is some bad news for Rafa Nadal fans. He's going to miss the French Open, and he's given some indications about the end of his career. On the other side, we bring you an ode to Rafa Nadal.